Well, hey everyone, it's your boy Warren Howe, and we are back with another video. We're back with another live talking about intrinsic valuation, part two. But before we begin, you know the drill. Yeah, you know the drill. Smash that like button if you haven't. Smash that subscribe button if you haven't. Smash that heart button, right? Show some love. We are live now. I'm live on another platform, but I'm actually recording this for a YouTube video. Again, smash that subscribe button. Increase the algos. You want to get more stock market updates. You want to get what's the market environment. I haven't been as active in YouTube. I should. We have been actually building thesis on a few companies, building strategy, right? Portfolio strategy. I'm managing a couple of funds, which is stressful at these times now. I'm not gonna lie, but what best way is it to do? I mean, what are we to do when the markets are going down? We should be building thesis. We should be building a game plan, right? We have been repeating this all the way ever since a few months ago. And what is the best way to do? We essentially want to learn new tactics, right? And learn new strategies, get the safest option as to what are we going to do. Again, in these times right now, when markets are dropping, when all the values are dropping, it's really falling into deep value, right? I would say. And certain companies, even the big guys, right, they're taking a hit, but will this hit last forever? So that's where we actually have to adapt a reasonable growth model. I'll be sharing my Excel sheet, right? I'll be sharing my cash flow sheet, just to see and gauge how, what do I do, right? What do I do when I want to project a model? We have series of models. We add up all the cash flows, discount it back to net present value to determine whether or not it's a buy. So that is essentially intrinsic value. That's all we have to do, right? Now, I'm going to be having a quick recap, and let me just share what we actually discussed the other day. So in part one, we discussed what is Apple's owner's earnings, right? So what do? We refer to the 10K. We basically have what Warren Buffett addressed in owner's earnings is, represent reported earnings plus DNA minus the relevant capex, right? Minus relevant capex, because that's what a business does to remain competitive, right? Airplane companies, they have to refurbish few interior design, just to be competitive, right? People are offering this product, this service, they have to remain competitive. How much is needed? How much capex is needed to actually upgrade or maintain the business? That's capex. You add in, well, you minus working capital, because that's how much they actually have to actually roll over. So you do all that, you can actually get the owner's earnings. The simpler concept, as we discussed in part one, check out the video if you haven't, is that we want to work out for you as an owner, right? You as a shareholder, how much cash do you have left after the business, right? So if you own a baby sensory business, and by the way, just to prolong the story of the baby sensory real life story, I lost the bid. And well, it's actually sort of like a blessing in disguise, right? I lost the bid. COVID happened. They had to shut down literally for 1 year with no revenue. So imagine you as a business owner, you pay 280,000 or 300,000, and you can't run your business, right? You probably took a loan, maybe, or you took it all in cash. If it was all in cash, is good, but imagine that cash being stuck there, not having to do business in over a year. Now that's a problem. So I lost the bid, and well, you could say I'm lucky, but I'm pretty sure now the situation in Malaysia is actually getting better. So pretty sure now they're earning, right? And that's when it comes to business, right? Businesses, there's risks. So stock market is going down because there's risk, because earnings, the E in the PE is dropping, right? The E in the PE is dropping, and analysts, or we need to be more conservative in our earnings projection. We can't be, okay, 15% growth all the way, right? 12% growth all the way, 20% growth all the way. We can't do that. So we have to be really conservative. And if we can get the E right, we can determine whether or not we can, we are paying for a good business. But anyway, so this is what owner's earnings. And we determined that in 2019, I'm going to use 2019 because that's when I did this slide. I prepared these slides to, I sell courses, right? I coach, I also coach one-on-one. So do let me know in the comments, or reach out to us, our website, My phone is in the website. Reach out to us if you want to, have this coaching, and it'll be good to have actually a decent plan for these times right now, right? Bear markets don't last forever. Now is the time to build wealth. Let's put it that way. Now is the time to build generational wealth, and these don't last often. Bear markets don't last often. In a 70-year period, or a few decades, there's only 11 bear markets. Let's put it that way. That when the market reached 20% below from the highs, the market's already down 23%. I'm talking about the S&P 500, right? The biggest market in the world. So these don't last often. What do? We build cash. We build liquidity. Cash is useless if we don't know how to utilize it. So we have to know what to buy. It's as simple as that. Build cash, build liquidity, know what to buy, know what you own, buying at a decent price so that if it drops 15% more, you're not afraid. That's the concept, right? That's the concept. Okay. You've been doing this, you will earn money in the market. It's only a matter of time. You don't have to be a trader if you don't have that portfolio strategy. You can be a long-term investor. You can still earn money. Now is the best time. You got kids, teach them about stocks. You want to learn about stocks, you can contact me, no problem. But the point is, you got kids, you want to buy stocks for your kids, right? You want them to learn what to buy. They know about Roblox. What is the DCF for Roblox? What is the owner's earnings for Roblox? Do you like Apple products? I just bought a new phone, right? Which is cool. I haven't changed my phone for like 5 years. So I bought a new phone. Why? Why am I still using Apple? They have the emotional power, right? They control my emotions. I want to get that new phone. It's going to be Apple. Why? The status. It's sexier. The graphics are better. It's an Apple, right? So why not buy an Apple stock? It's just 100 plus, USD, which is 400 plus ringgit, 500 ringgit. I can, with the amount I paid for this, I can get 10 shares, right? I can get 10 shares of Apple. Why not I buy? So that's the concept, because those 10 shares can potentially be, doubling your money in 5 years time, or, 6 years time when the next bull run comes up. So the point is, we're owning a business. These times are great because stock prices are going down. We want to work out cash flow for earnings. And in Apple's case, in 2019, I'm not going to say 2020. I'm just going to refer back to what we discussed, right? 2019. You guys can work it out yourselves. But the maths are all here. So 2019, owner's earnings for Apple is around 56 to 58 billion. Okay. So I'm not going to be moving on to the spreadsheet. By the way, before that, how do we work out the sum of all the cash flows? Right? How do we work out some of all cash flows? Do we just add 57B or 58B and times it by 10? Do we do that and discount it back? No, we don't. We don't do that because the 58B will grow. Now, a lot of work has to be done before we reach to this conclusion, right? Because if we want to project shit, we need to plan out and we need to assess whether or not the projected shit is right? So what do? What we do is basically we want to gauge a decent percentage of growth for this company, right? It all comes into play. Now, everything, when we want to work out intrinsic valuation, it's not just a matter of, plugging in percentages and shooting up the Excel sheet. What's more important is basically looking at the qualitative analysis to determine how possible they can grow. Now, Google is growing at double digits, right? 20% more. Not even at the 15% range. They're like growing 20%. So is it decent to put 20% on the growth and just continue on for 10 years or 20 years? No, we want to be conservative, right? So we lower that figure. How about Apple? Is it decent to plug in a growth model of 5%, 10%, 15%? Now, we also have to put in the likelihood of, their EV cars, right? Or the growth of iPhones, the growth of their iPads, right? If we look at the 10K and look at the breakdown of their products, their revenues, we can determine, how many percent they can actually grow in comparison over the previous years, right? So if you are an Apple fan in terms of the business, you'll see that iPad has been growing a lot. iPhone has been slowing down, right? In comparison. But because they have that services side of business, which has been growing tremendously and bringing in the margins, right? Services business, which is basically the iPhone, the App Store, right? App Store, everything that is services, everything that is digital, not just physically selling. They're not a hardware company, right? They're both hardware and software, and that what makes it sexy. So that side of the business is a cash cow. I mean, the margins are huge. The OPEX is not, spend a lot on there. They are not hit by cost of revenues because materials are increasing, right? Chip shortage, so it affects the hardware side of the business. What we got to do is we need to gauge, okay, how's the software side of the business? Is that growing? What are they doing? What is the future plan? If you're an Apple fan, you will tell me, right? What is the future plan? What is their product roadmap? Is it possible, knowing Apple, right? They're partnering with Ford or GM or whatever it is for the EV car. How possible is that? But it's hard to gauge. So can we not consider that into the revenue model? So these are things that we need to, fill in the blanks before we go into the Excel sheet, right? So a lot of gurus out there, they just, shoot up the Excel sheet and they say, oh, okay, let's plug in the model 1 to model 5, right? Let's go in 6% or 10%, 15%. Now I'm going to go back in the 20-year period and work out the intrinsic valuation. You do this at the last step. Okay. They don't talk about qualitatives. They don't talk about how much the business has grown for this particular model. You need to analyze it as though you're owning the business, right? You're an analyst yourself. We are all analysts. We need to analyze the business and talk about the qualitative stuff first, right? Which is the interesting bit because it determines whether or not there's pricing power. We determine whether or not there's demand. We determine how well their products have been growing, right? Revenue breakdown year over year, and we can get an average. We can get a CAGR, right? Compounded annual growth rate. Is it 15%? Is it 10%? You do all that shit before you go into the numbers. That's why qualitative over quantitative, right? So then I know what we did was basically, oh, Warren, you taught us about, okay, owner's earnings. That's cool. But it comes into a few, blanks that we need to fill. The first blank is, what is the growth rate we need to apply on Apple? You tell me, right? Remember, this is not a buy or sell call video. This is to basically let you guys have a gauge of, and just think about it, right? Ask yourselves, is 10% growth rate over a 20-year period for Apple decent? Is it a bull case? Is it a bear case? What the heck is it? Is it conservative, right? We will, after seeing, because there's a few tabs that we need to fill, right? Sales over the last 10 years, right? EPS over the last 10 years, equity, shareholders' equity, operating cash flow, which has been growing crazy, right? Really good. Maintenance CAPEX, which has just been stagnant and is very little, which is good. To determine the cash flow for owners, right? The owner's earnings. Once we do that, you fill in the long-term debt so we can get the ROIC. Then we can get the growth tab, where how much on a CAGR basis over a 10-year basis, how much did the sales grow, right? On average, 16% for Apple's case in 2019, EPS 20%. Shareholders' equity, seriously, not so good, because why? They are making use of, they're literally borrowing more cash, raising more debt when the interest rates are low. Why do they do that? Tax purposes, right? And they want to take advantage. I mean, it's practically free money. It's free money, right? They got 100 billion in cash. They borrow another 100 billion, paying 1% off, 1 to 2% in interest. It's practically free money. So that's what makes their equity not so favorable, right? So we don't just want to tie onto a specific, metric to determine whether or not it's a buy for a company, right? So why am I doing this model? Is because we want to gauge the growth rate of how well they can grow their cash flows. So remember, intrinsic valuation, this video is talking about all about cash flows, right? How well as an owner you can actually roll, right, with your cash flow. And I'm not just talking about operating cash flow. I'm talking about owner's earnings cash flow, right? So on average, it's about 14%. But this is 2019. You can assess it way back in the latest one using this model. Then you got a couple of models, right? You got model 1, which is 6%, and model 5, which is 18%. Now, honestly, over a 10-year period and 20-year period, what is the likelihood that you will buy another Apple? And bear in mind, a lot of people, they have more than one phone, right? When they use an Apple product, it's most likely they're going to use back another Apple product, right? Now, I admit I only have iPhone as an Apple product. I bought my wife a Mac. But why am I saying that? Is because it's easy to use, right? It's easy to use. If you the software is what ties them up, right? So if you use one product with the software that is actually interlinking everything, is most likely you buy an Apple Watch and whatever it is, right? So that's the thing. The question is, will there be a new Apple in 10 years time or 5 years time, right? Will Apple lose its market value because of that? Personally, I don't think so. So that's why the qualitative aspect comes in, right? The business sense of things kicks in. And that's where I'm a realist in. I don't just look at numbers. I look at, okay, will this business last for 5, 10 years? Then only I can do this model, right? And this model, bear in mind, not only brings in 10 years, right? It also brings in 20, it actually brings in 20 years because the terminal value, which is basically the cash flow for year 10 times another 10, because terminal value means stable cash flows, right? Where the business actually stops growing. So we need to determine the terminal value. What is the value that we think that Apple will basically just stop growing? And I know they'll be growing 20 years time because they're going to be innovating, but for cash flow purposes sake, discounted, intrinsic valuation sake, we need to work this out. So this, when we add up all, again, first, what is the growth? Yeah, what is the growth decent percentage that we want to be, that we think is decent for Apple, right? That's the first thing. The second thing, what is the cash flow for owners for that year, right? Because if you plug in 15%, 10%, then from year 0 to year 1, it grows accordingly, right? It grows 10%, it grows 10%, it compounds, it compounds, it compounds, because that's exactly what they have been doing as per the data input, right? Cash flow for owners since 2010 was 18 billion, and in 2019 is 60 billion, right? The question is, will they continue to grow, right? So what we do is we add up all these cash flows, right? We add up all these cash flows to determine the intrinsic valuation. Yep. So step 1, fill in the growth percentage. Step 2, fill in the owner's earnings that you worked out. Step 3, determine what is the risk-free rate. Now, in this environment, when interest rates are going up, bonds are actually going up, right? So that means risk-free assets, risk-free investments like bonds give you a better return. So that's why it will affect all companies' valuations, because if we worked out, okay, 20% growth or 15% growth for a company, we need to discount that back because, I mean, time value of money, right? In 10 years' time, your money is actually worth less because of inflation, because of, basically because of inflation. So what do? If you increase the risk-free rate to 5%, then you will see that the intrinsic valuation goes down. That's why everything is re-rating, right? Because as interest goes up, risk-free, assets go up. These assets are worth less, right? You need to be discounting and saying, oh, you know what? My required rate of return a year is 10% for this company, Apple, but I got a risk-free asset for 5%. Why don't I just put my money there, right? So that's why the whole market is going down, especially for non-profitable companies, right? Imagine. So risk-free rate, let's say 5%, and it changes the intrinsic valuation. But let's just put 3% for, there's no way they're going to go 5%. It's going to be Armageddon, but who knows, right? So for this sake, I'm going to go 3%. The intrinsic valuation for at a model of 10% will bring Apple's intrinsic value at 1.9 trillion, right? So what is the buy? How do we determine the buy price? Why should we be buying at 1.1 trillion? Why? Because this this formula actually calculates the net present value, NPV, over the required rate of return, and we add up all the cash flows, right? From this period to that period. Okay. So if your required rate of return is 10% a year, then you need to only buy Apple at 1.1 trillion. Now, I know what you're thinking, right? You're thinking, fuck, Warren, their market cap right now is at 2.2. Let's check. Apple market cap is at 2.1, right? 2.1 trillion, right? So I'm going to wait forever. They might not even reach 1.1 trillion, right? That's true. That is true. Again, this model is very safe. This model is very, very safe. First of all, it incorporates the cash flows. It does not factor in the premium that the market is giving them. Seriously, do you think Apple is, I mean, with a P ratio of 21, I was looking at Apple when they had a P ratio of 15, right? Do they deserve this premium in a re-rated market? Maybe they do, right? Maybe they do because it's Apple, right? There's a software part of it, there's growth, it's stable, they're giving dividends. The market is assessing this overall and saying, okay, they're worth 2.13 trillion. But in the re-rated market, I think there's still a lot of downside to go down. The question is, how much downside can they go down further, right? The second question is, can they really grow 10% only? Or is it 15%, right? I would say 15% is a more decent model based on, what we worked out in the growth table, based on what we can see qualitatively, right? Their cash flows have been growing tremendously. We can actually use if you plug in 2021 figures, I'm pretty sure the cash flows are much more than that, right? But the point is, we need to determine what is conservative, what is bear, what is bull. And if we can work that out realistically without lying to ourselves, then we can just be patient and wait for the market cap to go down. Then only we can place that buy. So again, this model is very safe, which is good. Safe means good. I want to be safe in this environment, right? Markets are going down. I want to be safe. So I wait out. I'm not going to panic buy right now because 2.13 trillion, in my opinion, right, is not that buyer price if I want 10% a year. And bear in mind, 10% a year, if you know that it's a safer model, you can put more money into it and know that your margin of safety is there, it's cushioned, right? So again, if you increase this, obviously the buy price will go down. Well, it's impossible. I mean, anything is possible in the market. But if Apple drops down to 1.3 trillion in valuation, then the whole market is going to drop a lot, right? But 15% for this company a year, right, for 10 years is asking a little too much, right? In 20 years, asking a little too much. So 10% I think is decent, 12%, whatever you want to adjust it. Then we got that's why there's a couple of things to fill in, right? We got 15%, we got 18%. I personally think 18% is achievable, especially if we prorate it out over the years where they innovate new products, new EV car. What is the sales on EVs? EV is the new hype. They're actually doing the correct thing, right? There's a product market fit. So the intrinsic valuation over a 10-year period will be 3.5 trillion. The buy price in order to have 10% year over year will be 1.9 trillion, which is actually quite close to, what's happening. So I'm going to be patient. I'm going to be patient and wait it out, buy it at probably 110 bucks a share, 115 bucks, whatever it is, right? Because it's Apple. Yeah. So again, this is DCF. This is intrinsic valuation. We worked out what is terminal value. We worked out how do we plug in growth rates with this model. What is the risk-free rate? We plugged in what is the required rate of return, and you will get a decent buy price. Yeah. So hopefully you guys are actually doing this thesis, building up your own models, right? If you want this, just hook me up, let me know, talk with me. We can actually have a good chat, and I'll see you in the next video. Thank you.